Learning objective 2 is short-term debt. Short-term debt, by definition, means loans that you have that are going to be paid within 1 year. That's why it's short-term. And the entry is very simple when you first get the loan. Cash goes up, and the liability for short-term debt also goes up. The income statement impact is zero at the time of funding, but thereafter you owe interest to your lender. And at that point, interest expense will be accrued and paid. GAAP has us accrue the entry if we owe money that's not yet paid but still owed. Here we notice that January 1st we borrowed $1,000 and we got cash and we increased the payable. Then at the end of March we accrue quarterly interest. The interest that would be due is we take the principal right here, the $1,000, times the interest rate, in this case 12%, then multiply times the portion of the year outstanding. So March is January, February, March, 3 months out of 12, so 3/12, and we get $30. So at the end of March, we would accrue by recording an expense and a liability. So here's the liability, $30 we're going to owe the bank, and the expense, $30 of interest expense. Now notice that March 31 is the statement period. Now in April, we pay the interest. When we pay it, we reduce cash, $30, and we reduce the liability, because we won't owe it after that, of $30. We record the expense in the month, or in this case, the quarter in which it's incurred, and we pay it when we pay it. And then we have no income statement impact because we previously provided for that. In addition to short-term debt, also included in current liabilities is the current portion of long-term debt. That's a mouthful, but what it means is even though you may owe money over a period of time, you must reflect what's due in the next 12 months. This would be an example. Let's say you have a 5-year loan, and every year with the bank, you have to pay back a certain amount of principal. This would reflect how much you have to pay in the next 12 months. Here's an example of Verizon. For 2015, it breaks out what is due in the next 5 years, 16, 17, 18, 19, 20, and then thereafter. This portion right here, the $6.3 billion, is due within the next year. Even though the loan is a long-term loan, there is a current amount due in the upcoming 12 months, and that's $6.3 billion. That must be shown as a current liability.